You can
Yeah.
go. Okay, you can introduce yourself again. Just
Okay.
start over.
All right, Mel Lynn, I've lived in Stonebridge for almost 11 years. My background, my education is, I have a PhD in microbiology and spent most of my career working in the pharmaceutical new drug R&D area, especially in infectious diseases. And as I began, about halfway through my work career, I began to think about retirement investment and decided that it was too important a topic to give to somebody else. So I did educate myself about this. So I read quite a lot about investment strategies or whatever. And for the most part, I'm not really much of a trader. I'm kind of like more of a passive investor, except for what I'll be talking about today.
Okay, so I can make you co-host more, and then you can share your screen.
Okay.
Okay, you're co-host now.
Okay. Okay, can people see this?
Everyone see this?
Okay,
Yes.
can you see my PowerPoint thing? Yes?
Yes, it's up on the screen, Bill.
Okay. So what I'd like to talk a bit about today is using options as part of a bond replacement strategy. As I approach retirement, like many of you, I decided to keep about a little more than half of my portfolio in bonds as a kind of way of balancing out equities. But with the arrival of 2008, 2009, and then again last year with the COVID thing, bonds to me became kind of a difficult area to invest in because they pay very little. They don't keep up the inflation rate, and they seem to me to be quite risky. So I began to look into other areas that would basically act like a bond. That's so-called bond replacement strategy. So I began to look at equities that were basically value stocks that paid greater than a 4% dividend and had a history of annual dividend increases for at least 15 years or more. I'm looking for companies that had rock solid balance sheets, and I was not that interested in this part of my portfolio, capital appreciation, but really mostly all about yield and stability. So I began to look into a number of areas, and I kind of focused on selected preferred stocks, which last year in the springtime, there were some great bargains out there because of the COVID lockdown. And stocks, but preferred stocks that were usually priced around $25 were now available for $10 to $15 for companies that were really rock solid. I also began to look into selected REITs, real estate investment trusts. And there were also some great bargains at around the same time last year because a lot of places were locked down and people just sold off of REITs as a general class, even though several of them continued to pay out more than 95% of their expected rent that they collected. So the yields we're looking at around 5 to 8%. So I'd used puts from many years before that as a way of initiating a position in a stock or an index. My view was that if I saw something I wanted to buy, I would buy about 25% of what I considered to be a good price. And then I would sell puts for lower prices and wait for them to trigger. And if they didn't trigger, well, I collected the premiums and waited until they did. In almost all cases, this happened. Now, this doesn't work very well with a lot of growth stocks because they just kind of take off, but it worked pretty well. Let me talk about a couple of terms before I get into more detail here. And by the way, this is not a course in options. This is a course in how Mel does options. So there's lots more to know, but okay. So the terms I'm going to be using today One of them is cash secured put. Another one is covered call, and a third one is in the money. Now, a cash secured put means that to sell a put, you must have the cash in your account to cover a potential purchase of the stock that you're selling the put for. And so the amount is the strike price, which is what you target that put to be, times the number of shares during the term of the contract. So for example, if you were selling a put for 100 shares of a stock with a strike price of $70, that means you need $70 times 100, or $7,000 to cover that one contract in cash in your account. Now, it's not really locked up. Cash just has to be there, so you can still be earning the money market rate or short-term bond rate or whatever. Now, what is this cash secured put? The buyer of the option has the right, but not the obligation, to sell the stock at the strike price prior to or at the expiration date. So why would somebody buy this thing? Well, let's say you had a lot of shares in AT&T, and you wanted to protect it so that you got at least $30 a share if the stock tanked for this period of time. If you bought the put at 30, no matter what happened to the stock, you would get 30 at the expiration, right? I don't buy them, I sell them. I'm the insurance guy, so basically. A covered call, similarly, the prerequisite to this is that you must own enough stock to sell if the price is at least the strike price. People who try to sell calls without owning the stock are taking a huge risk, because if the stock really takes off, you've got to buy the stock to deliver it at what the strike price. And again, the buyer of the option has the right, but not the obligation, to buy the stock at the strike price prior to or at expiration date. The other term is in the money. For a put, a current stock price is at or below the strike price. In other words, if you for a put option for a stock that has a strike price of $70, and the current price is $75, it is not in the money. It is only in the money if it's at $70 or less. Okay, that becomes important, and I'll talk about that. For a call, the opposite is true. The in the money current stock price must be at or above the strike price. Okay, so when you sell options, you get a premium, right? The premium can vary depending on a number of factors. Number one, the volatility of the underlying stock. God forbid you were to be selling options for something like AMC, which is a very volatile meme stock. You could get a lot of money for selling the option, but the bad news is you may someday actually own this stock if you do that. So there's that. For a more stable stock like AT&T, the premiums aren't going to be that much because the volatility is pretty low. So what you got in the value of the option, there are two parts. There's a time value, which is the part of the premium that is related to how much time is left to expiration. So the more time that's left, is there more value to it, okay? So that if you were to sell a put for a year out, you would get more money for the same strike price than if something that only goes 1 month out. I'll show you that in a little way. The other part is the intrinsic value. This part of the value only is anything but zero, is only more than zero if it's in the money. So again, if you, well, I'm going to show you that in a little bit. Just to be sure, just to be clear about this, I only sell options as an opening to open a position. I only sell them. I never buy them because I think, and I'll show you why. But I may buy them back to close a position at some point. Talk a bit about that too. So let's go through some examples and kind of like clarify what I'm talking about. All right, one of the stocks that I follow pretty closely is one called WP Carry, which is a REIT, one of the biggest ones, and a dividend aristocrat. The current price of this stock is, as of September 2nd at 11 a.m., when I wrote this up, was $78.85. And it paid a 5.4% dividend. Well, that's pretty good. But in order to try to enhance the amount of the dividend that you get, it's not really a dividend, it's a premium. If you were to sell a put, let me get my pointer here, with a $70 strike, which is what, $8.85 lower than what the current price is, with an expiration date of November 2021, you would get 50 cents per share. Yield of that is 0.7%. And if you annualize it, because this is 2 months out, you get to 4.3%. Bad. If you were to sell the same put, but with a longer expiration date, let's say January 2022, which is about twice as much time, which is a little more than 4 months, you would get $1.20 per share. The yield here is 1.7%, and the annualized yield is 5.1%. All right, better. If you were to take a little bit more risk, the chances of WPC Carry going down to 70, in my view, is pretty low within 2 months, and it's equally low within 4 months, but you never know. It could happen. I would love to buy this stock at $70. I would absolutely be ecstatic if it dropped down to $70. But I can get more premium if I were to go closer to the strike price. The strike price was closer to the current price. So, for example, for the same two puts, for the November put, I can get $1.45. That's a 1.9% yield or an 11.6% annualized yield. When I talk about annualized yield, I'm just hypothesizing here because there's almost no chance you can sell the same thing over and over again and get the same amount. Things change, the prices change, and all of that. But just to give you an idea, so if I were to sell this annualized, that means I'm getting the 5.4% dividend. Well, if I just bought the stock, I would get a 5.4% dividend, but I get double that if I just sold the puts and didn't own the stock yet, right? The January put, I would get $2.55, a 3.4% yield, and the annualized yield is 10.2%. Now notice that this is a little lower than that. This is just a variation of what the bid and ask prices are. This is nothing particularly unusual about that. But notice that the closer the strike price is to the current price, the higher the premium you get. That's the way puts work. Calls work exactly the opposite way, right? If a call doesn't work the opposite way. If you've got, let's say, you want to sell a call for WPC Carry for $70, you get a lot of money because it's so far away from the current price. The person who would own that would be able to buy if price was at least $70, would be able to buy it for $70, even if it's $78.85. But I don't want to confuse things. So let's move on here. So what happens at expiration? About 70% of options, and I've heard all kinds of percentages here, but it's clear that the vast majority of options expire worthless at expiration. So if the stock price ends out of the money, you have your premium, you walk away, and you can sell more puts with the same amount of cash in your account. So this is where the annualized yield comes from. Now, what happens if the price is in the money? Meaning, what happens if carry goes from $78 down to $70? Well, at the expiration date, or maybe before, the stock would be put to me. In other words, I would see in my account, I bought this stock for $70. Again, I would be a happy man if that happened. But so the effective buying price is the strike price minus the premium. So let's go back and take a look at that. So if I had a 75 strike price, right? Stock ended up at $74, something at expiration. I would be buying the stock $75 minus $1.45 by November. So that means my effective buying price would be what, $73.55, which is a lot better than paying $78.85. And I get paid to wait. Okay, let me proceed on here. So what happens if the price is in the money? Well, your stock is put to you, right? Now you have three options here. I shouldn't use the word option. The three possibilities. You can say, okay, that's great. I love buying the stock for this price, and I'm just going to keep it, right? Or you can turn around and now sell an out of the money call, covered call, and collect a premium for that. So let's say I just had bought the stock for $70. Now I can turn around and sell a call for $75 for a couple of months out and collect the premium. So if it goes to 75, now I've made $5 or more than $5 profit, and I've collected the dividend in the interim. So that's one thing you can do. The other thing you can do is just simply take your premium and walk away, right? Or you can even, before the expiration comes, if the price of the option is dropped because the stock is still out of the money, you can close out the position by buying back the option and doing something else with it. So for example, my rule of thumb is, let's say, let me go back and look at, and give you this number again. Let's say I collected $1.45, right? Now November is coming, or the price has gone up. When the price goes up, the value of the put goes down, right? When this value becomes something like 15 cents, I'll just buy it back. I've already made 90% of what this premium is, and so I'm selling it back for only 10%, right? Now I can start another position with that, rather than just waiting for the expiration to happen. Okay. The other thing you can do, and I don't recommend this for beginners yet, is something called roll forward. In other words, you can close out, if the value has gone down, but not maybe 90%, you can buy the position back and then do something else with you. You can sell another option further out. Remember, the further out you go, the more money you get. Okay, before I take some questions in a bit, but let me give you some cautions here before you start running out and doing this thing. First of all, my rule of thumb, don't sell puts for stocks you don't want to own at a strike price. I don't want to own AMC ever. Not for $1, not for 50 cents. So I am not going to sell puts on AMC, even though I can make a fair amount of premium. WBP carry, I'd love to own this stock forever, as long as the stock stays as good as it is. Okay, very important is point number 2. One option contract is for 100 shares, right? You don't want to go out there and buy 100 put, sell 100 put options, because you just may just, first of all, your brokerage won't let you do it, hopefully. But 100 shares, 100 contracts is what, 10,000 shares. Don't do it. So be careful about what your numbers are like. Remember, one option contract is for 100 shares. Okay, the other thing I've noticed is that the bid and ask spread is usually highest in the first hour of trading. So beware of early market orders. What some traders like to do is they like to offer to buy something back at some ridiculously low price. And so the early traders were not experienced and go out there and do a market order, they're going to get creamed. Either that, or they're going to pay they're going to get very little for what they're selling, or overpay for buying something. So be careful about bid and ask price in the first hour of trading. You'll notice that if you watch these things, the bid and ask shrink as the day goes on. All right. you need to get approval from your brokerage before trading options. Right? There's a document that they'll send you that you have to read, and then they're going to do a questionnaire and a survey. Fill out the survey as a very conservative investor would. They want to make sure you're not going to be taking too many risks with your money and that you're not going to get an overhead. When Robinhood first came out earlier this year, there was one kid who was trading options, and he opened up his account one day, horrified at what he saw, he killed himself. Right? So that has happened. Robinhood is really not a very secure place to trade if you didn't know. I'm telling you, don't trade options on Robinhood or any place like that. Go through, your reliable brokerage account. They'll hold your hand and make sure you don't do anything really, really dumb. At least they'll try. I suggest you do this on paper first, just to see how it goes. For example, if you were to, let's say you own 100 shares of AT&T, right? Current price is something like $27 or something. And let's say you went out and you sold a call for 30 or 35. Then in the next month, while the contract is still valid, the stock somehow zooms to $70. How are you going to feel? Are you going to feel dumb? Are you going to hate yourself for having sold the call? Well, if you are, then this is not for you, because you're not trying to guess the actual price. What you're trying to do is milk the cow. Is basically what we're trying to do here. So do the paper trade first and see how it goes for a couple of months, and then see how you feel about it. The other thing, one last thing, when selling covered calls, keep the divvy X date in mind, because a lot of traders will exercise in the money calls just before the X date so that they get the dividend. And if you don't pay attention to that, you lose out on the dividend. So you may lose out a quarter's worth of dividends. Usually I haven't seen puts exercised early, but I've seen calls exercised early. Okay. Len, do you want me to show the ETF information?
Yeah, why not?
Okay. And then I'm going to take some questions. Okay, so Len provided this to me. If you like the idea of options, but you hate the idea of all this paperwork and machinations and all of that, you could just simply buy an ETF that does covered calls. I'm not aware of too many ETFs that really do puts, but maybe there are. I don't know. I don't really do it. One is this QYLD, which is the largest one. And this is basically a covered call ETF. And what they do is they buy they buy the NASDAQ 100, and then as a well, the index. They buy the index, and then they sell covered calls on it. And they've been doing pretty well. I mean, like every quarter they make like 8%. That's good if the market is relatively stable and not running away in the upside. If it goes down, well, it's not so bad because you still collect the premiums and you have to sell the stock. I will point out, however, that this is not in the same category of what I've been talking about, what I do. This is not a bond replacement strategy. Here, you're basically looking at very volatile stocks, the NASDAQ 100, and you're selling calls on it. This is not a bond replacement strategy. This is a kind of an investment strategy. I don't do it, but I said I'd put it up there. Len, do you want to make a comment about this? Len?
Yeah, I'm just trying to get a couple people in the waiting room. I'm sorry. What did you?
Okay.
I didn't hear you, Mel. I'm sorry.
Okay. What I said was that buying this ETF, QYLD, based on what I read today, it's very big. This is not a part of a bond replacement strategy because these stocks are very volatile and they're not really value stocks. And that makes quite a bit of difference as far as I'm concerned. This is basically just enhancing your equity part and not really replacing it with a bond-like substance. So anyhow, so I put this up there. You can go kind of look into it. They give you some ideas here about when not to buy a covered call ETF, when the stocks are generally rising and making new record highs on a daily basis. Because when you sell a covered call, you're limited on what your profit is. Okay, so you'll collect it, but it's not as good as holding the index. These, I guess, professionals running these things, they might be appeal to somebody, but not personally to me. So, okay, do you have any other comment?
Only that the ETF that you just mentioned, it has a relatively high expense ratio because it's actively managed. I think it's 0.65 or something like that. So that's, but you can do a Google for covered call ETFs and you'll come up with a website or websites that cover that particular area. We're recording this session and we'll do our usual MO, upload it to YouTube. It may take a few days, but Mel has agreed to answer questions. So
I'm going to stop the share, okay?
Oh, you want to stop the share?
Well,
Okay.
because that way I can see people's faces.
Yeah, okay, that's fine. I'm having some issues with, okay, all right, now I'm okay. Okay, so Mel is agreed to answer any questions if anyone has them. As I said, the whole thing is being recorded, so we'll have that posted up on YouTube. So you can review it. And I'm sure that Mel, living in the development, will accept email, if you have a real question.
Absolutely.
Yeah. So are there any questions? Anyone have any comments? Mike, Morley?
Yeah, I have a question.
Yes.
How much time you need to spend, and if it really kind of a sizable percentage of your investment, or it is just a fringe investment?
Okay, that's a good question. I look, whether or not I did options, I would probably spend about 2 to 3 hours a day looking at financial stuff just because I'm interested in it. But this gives me something to come and focus on. I think what most of the time I spend with options is finding the right companies to sell puts for, right? I mean, I have certain criteria. I don't have kind of like a spreadsheet kind of thing. But I'm looking for solid companies that pay a good dividend that I wouldn't mind owning for a long time. So I follow them to make sure that they're solid and not being affected by daily events or whatever. So it takes me a couple hours a day to kind of review things and narrow things down. I do a lot of reading on Seeking Alpha. What happened here?
I think you're sharing a screen or something. You want me to, I mean, I could,
Okay.
I could take you away from being the host somehow, but anyway, just continue, go ahead. You can,
Okay.
just say stop
like
share.
Yeah, like I said, I spend most of my time with options, investigating companies and reading up about it to have daily events happen. So for example, back in when the COVID lockdown happened, I really spent a lot of time looking. I had followed some of these companies, but now I did a deep dive to make sure I knew what I was buying. So, and that way I was able to take advantage of the plunge in prices and buy them at a really good price.
Len, I've got a question for Mel.
Yeah, go ahead.
Yeah, Mel, how long have you been using this strategy?
I've been selling puts for about 10 years as a way of kind of buying stocks. just so that I could buy them cheaper because I'm a cheap son of a bitch. But I've been doing this strategy ever since I thought that bonds really not a good place to be. So that has been the last 2 years or so.
And how many stocks would you have in a portfolio that you do this with?
I only have 3 stocks that I'm really consistently selling puts for, and one of them I'm about to stop. The two, and I'm not making a recommendation, but FYI, the 2 REITs that I'm really I sell puts for regularly are Realty Income, otherwise known as O, and WP Carry, which is another one that I do. I also did AT&T, but I've been disillusioned with them now that they're going to be cutting their dividend by half. So I'm going to just let those puts expire if they can, and if not, I'll just if they get put to me, I will start selling calls again. But I'm not going to be selling any more puts for AT&T.
And is that your whole portfolio? In other words, are you doing this with other stocks, or you just have 3 or 4 stocks and that's it?
Well, that's, yeah, I mean, I don't want to spend my whole day doing this. I mean, my aim is to make enough money to pay my Stonebridge annual monthly fee. So I do this to keep myself entertained mostly, but making money is nice too.
Okay, do you have any idea the kind of performance? Number one, what's the performance you would expect? Rate of return, and what is the actual performance?
Well, like I said, I'm looking to earn something like 10% a year on my money selling puts. And then once I acquire the stocks, then of course I'll be collecting the dividends as well. And if I decide to sell calls, I'll be collecting that as well. So maybe you don't quite get as much money on calls unless you want to sell at the money call. So I might get about another 5% a year by selling calls. But that's not bad in today's environment as a bond replacement strategy, considering that most bonds you're going to get, I don't know, less than 4%, much less than 4%.
What's the worst thing that happened with this strategy that you had over the last couple of years?
Okay, so I'll talk about my AT&T ones. Worst case scenario for me is that I've been selling puts for when the stock was around 30, 31. I sold puts for 28 and 29. Okay, it looks like I'm going to get the stock put to me on 29 for sure, because the stock seems to be staying on the 28 right now. So the worst case scenario, and it wasn't big numbers, okay? So I'm going to be ending up getting a couple hundred shares of AT&T, and I'm going to have to see how that merger thing happens and whether I want to stay with it or not. So the worst case scenario, until when I get it, I'll still be collecting up until the time that the merger goes into effect. I'll be collecting 6% until they decide to cut the dividend sometime next year. And at that point, it's going to be cut in half. So I'll be collecting a 3% dividend, which is not horrible. And AT&T is a cash cow. So I'm not concerned about it like going out of business or anything. So I'll take a little bit of a hit on my capital, whatever. But I trade all of this in my IRA, so I don't have to worry really about capital gains or losses.
Mel, you will get the stock, the new stock. You'll get, because I think AT&T will own 70% or something like that.
I'm sorry, I missed some of that. Something about AT&T?
I said you'll get issued the new shares, because I think AT&T will own 70%. So
right. Yeah, I'll be getting that too, but I don't think that's going to pay a dividend, will it?
you could sell those and buy more or whatever.
True. So that's my worst case scenario of what I've got. I'll be more than happy if every put that I have out there for O and for WPC gets exercised, because those are great stocks and I'd be happy to buy them cheap.
All right. Are there more questions? Mike, do you have any comments? Mike Bauer, you have any comments? I can't, you have to unmute. Down in the lower right, I mean, lower left.
Okay, I got it.
Okay,
Okay, can you hear me now?
yes.
Okay, great. So Mel, what of these two companies that you either sell puts or covered calls, whichever you do, what is the total percentage of those two companies to your total portfolio?
Oh, I would say each one is no more than 3% of my total portfolio.
So both of them together is 6% of the total portfolio.
Yeah. I mean, look, I mean, it's nice to get the extra money. I'm doing this to keep myself entertained mostly because I can't stand the thought that there's free money out there that I'm not getting any of. And
Okay.
basically, to me, this is free money.
Okay. So the only thing that I have an objection to is that when you own bonds or fixed income in the portfolio, that's a completely different strategy than using either covered calls or selling puts, okay? Where you say with puts and calls, you're exposed to the equity market. Come hell or high water. It's either good, which has been sensational over this last 14 months, or not. The bond part of your portfolio or fixed income or bond funds is a totally different balancing mechanism at times. What you're really explaining to us, with 6% of your portfolio, you're squeezing the last penny out of it by adding the dividends and whatever premiums you get paid. I understand that, okay? But I want the rest of the folks that may be on this call to know that what you're doing, and you've said it before, is you're taking 2 to 3 hours of your day on 6% of your portfolio. And you like it, which is great. You enjoy it. I think for the more casual investor, okay, you can make a case for selling covered calls. We do that. Puts is a little more, but you got to stay with that day in and day out if that's something that you like to do. You would agree with that, I would assume, yes?
I think your points were excellent and well taken.
Okay, so for the more, I think we have more casual investors here. I'm thinking, unless somebody says not, that may or may not want to spend the amount of time that you put in on these things. And I think you've done a lot of homework. So that's great. And it's just like you say, it's a matter of return on the time that you put in for your investments here. Okay. I think that any of the investment club members that are looking to squeeze a little more, as you would say, out of their investments, we've spoken about that before, look at a number of ETFs or bond funds. There's risk anytime you're squeezing anything more, there's always risk. But you wouldn't have to spend the hour or 2 or 3 that Mel puts in all the time to get the additional pop that you may be looking for from that point of view. And yes, there's risk with that too. Okay. I think that's the only point I wanted to make.
Okay. All right. Does anyone have any other questions? Doesn't have to be related necessarily to what Mel talked about, if you have any questions, because the purpose is just to have discussion.
Yeah, Mel, I have another question. When you look at a company, how do you evaluate whether it's something you want to own or not own? What's your criteria?
Well, first of all, how many years have they consecutively raised their dividend? This is like the number one thing. Secondly, how have recent events affected their ability to earn money? So, for example, last March, we discovered a lot of really good companies had suddenly a lot of trouble making money. I mean, a lot of other REITs that were invested in hotels or movie theaters or gyms and things like that suddenly weren't collecting their rents. Maybe they were collecting 40%, and suddenly the dividend was now in jeopardy. Fortunately for me, the price of all REITs went down. So I took advantage of that because these two really never skipped a beat on their ability to collect rents and therefore pay out dividends. So that's really what I was kind of looking for. I'm not looking for capital appreciation. I'm looking for a solid company that's got a big moat around it as far as collecting, making money.
So Mel, what percentage of your portfolio is in growth?
I didn't understand
I'm
that.
sorry, what percentage of your portfolio is in growth, in the growth sector?
I mostly, my equities are all indexes. I mean, they're all S&P 500 or equally balanced 500. But
And
right now, I'm a little concerned about the overall 500 indexes because they're mostly about 20% of it is in like 5 or 6 stocks.
sure,
So I'm going more for, I have some of that still, but I balanced it out by now buying equally balanced 500 indexes.
okay, so the indexes are the 500 indexes are the growth part of your portfolio?
Yes.
And what percentage of those to the total portfolio?
Well, that's about 40% of my portfolio.
Okay, and the
Now,
other,
I'm not saying, I want to be clear, I don't not own any bonds. I own some short-term bond funds. I'm just not convinced that long-term bond funds are the riskless thing that people think they are. They're not, because sooner or later, interest rates are going up. Maybe they're going up now. And that means the prices are coming down. So that's also to be considered.
right. So in that case there, what generally happens is, as long as you have a long-term outlook, is those same managers that are running the show, as their short-term or immediate-term bonds keep coming due every week and every month, right? Because you're talking about fund managers that probably manage hundreds of millions, if not billions of dollars. So they have it constantly coming due. So what happens is, as new paper comes out on the street every week, more than that sometimes, they will start to buy the high yielding. May take them a little while to catch up, but they'll start to catch up as their lower yielding expires, okay? So that's one part of that. That's generally how those portfolios work. So what is the remainder? So 40% is this growth 500 index. What's the other 60%?
I've got a fair amount in preferred stocks, and I know that, again, I know that they can be somewhat fluctuating. I'm glad they did fluctuate when I bought them because I got them really cheap. They're in solid companies again, and right now it's really hard to find a good bargain in preferred stock because everything is priced at $25 or higher.
Right.
Unfortunately, I loaded up the truck last year when things were under 25 and under 20 and under 15 sometimes. So that's the remainder of my so-called bond portfolio.
So that's really your fixed. So you move somewhat from bonds to preferreds, which on the debt scale is a little riskier, but most of the preferreds that have been issued are generally from financial institutions, right? Most of your preferreds are anything from JP Morgan to Bank of America to maybe MetLife. Is that true? Wells Fargo, maybe. Is that where most of your preferreds are?
Actually, I've been buying the Wells Fargo L, which, as you know, can't be called.
Right.
It can be called, but it won't be called.
Right.
And that, that pays, or what does it pay? Over 5%, about 5%.
Sure.
Which is okay. That's a bond-like equivalent for me.
Okay. That's good. All right. So basically about 40% of your portfolio is exposed to the stock market. So if the stock market retreats 5, 10, 15, 20%, the total value of your portfolio will generally follow that step down, the 40% of that. Is that pretty much it?
Understood. And that's the risk I take.
You're willing to take that risk. Okay. Got it.
So what's the alternative? If you are not in the stock and it is going down, it goes down sometimes. So are you sell them?
I'm not sure. I'm sorry. I missed that, Mel. What was the last?
I mean, no, it wasn't Mel.
It's all.
Yeah, I'm saying that you're saying that if the index fund will go down, then you lose. But what's the alternative? I mean, you don't buy and sell all the time according to what you think will happen. You just keep it, and on average, the index fund like this S&P 500 making 12% or so, right?
Well, you're
Over a
only
longer
making
period.
it, you're only making it when you sell it, okay? You may have had a gain, but you can just as easily get back that gain the next year, okay? So it sounds like for the most part, Mel's got most of, or at least 60% in income producing, which you say this is all in your IRA. Are you right? You said that before? Most of what we're talking about is your IRA? Is that right, Mel?
Well, okay, so I have about half of my portfolio, the index part is in my non-IRA.
Okay.
Okay, so that way, if the things tank, I can, sell them off and take a capital loss. The
Okay.
bond stuff is mostly in my IRA or
So-
the bond-like stuff.
So are you eligible yet for RMD, or are you too young for that?
Oh, I'm definitely taking, I'm 75.
Okay, so your income that you're producing helps you get to your RMD. Whatever goes up or down, you start to, in other words, as you have to take out starting next year again, your income covers pretty much your RMD. Am I correct when I say that?
Yeah, I mean, I use most of my RMD for charitable purposes.
Oh, okay. Well,
So, okay,
whatever.
so even if I have to take it, it really doesn't affect my tax rate that much.
Well, and your lifestyle. Okay, so that's something that's, that's fine. That's great. Okay.
All right. I think that I'm looking for more interest for other speakers. Besides, if we have more resources within the community, I will go with that. People who'd like to talk. And you could get in touch with me if you have a topic and we can discuss whether it's appropriate. Gary Lauren, you've been quiet. Usually you have questions.
Yeah, and it's I've sold chemicals, occasionally some puts, but it's not a big part of what I do, so don't have too much input.
Yeah. Okay.
Glenn, can you fix the screen, or is it just my screen?
I don't know what happened. It says that it's Mike Eisner's inbox, and I didn't want to play with it because I don't know why he has put why this is up on the screen, because as far as I know, he's not a he's not a host.
Okay.
Yeah, so I don't understand what's going on. And I didn't want to play with it. Maybe Steve knows why this is up there. Steve?
It's
I
not just my
have no
screen.
idea.
Yeah, I don't know. This is Zoom, and I'm still learning all the nuances of Zoom. For instance, on the personal version, I can't make someone a co-host. I can make them a host.
Mm-hmm.
On the version that Stonebridge owns, this is like a professional version. I can make co-hosts. I can make as many co-hosts as I want. So that's it.
There you
Okay.
go, you
And
fixed
now
Somehow
Now we
Mike
got
must
you.
have heard me
we
and
got
cleaned
you.
it up.
Yeah. Okay, that's good.
Anyway, that's where we are. At the moment, Mel, traveling as alias Sylvia, is a co-host. Yeah. And I'm the host. So if there aren't any other questions, as I said, we recorded the presentation and it will be put up on YouTube, and I'll have it sent out. Now, everyone who's a member of the investment club group or whatever, committee. I don't know what they classify as. We're a committee, I guess. Then I put the notice up on there, and I'll put the YouTube link up there once it's posted on YouTube. So if you're not a member, send a request or to be a member, and so you get into the group and get access. I mean, my initial plan is still formulating, but my intent is to post various stuff, like from Seeking Alpha or Barron's or something like that, that might be of general interest to people. I did put one item up on China. I made an investment recently in a company that is China's oil and gas company, natural gas company, called Petrochem, symbol PTR. I'm not telling anyone else to do that. Right now, I'm a little underwater, but I read an article listing companies that the Communist Party owns. In other words, it's not one of the technical companies like Alibaba or Tencent. So I figured that the companies that the Communist Party owns not going to get subjected to the same treatment. I might be wrong, but so I bought into PTR, and I find that the best price is in the pre-market, and that's when I've been buying it. But as I said, I'm a little underwater, not much, but that's the only China stock that I would buy. I wouldn't buy any of the technical things at the moment because things are still too unsettled.
But is there any risk owning Chinese stocks because they don't really follow the requirements of NASDAQ or the New York Stock Exchange? I mean, it seems like they could be delisted at some point. Is there an issue there with Chinese? I never touched them because of that.
Yeah, you don't know what their financial, like supposedly some of the companies, you don't really own the company in China. You own a shell company that I forgot what it's a variable interest company. You own the shell company that has some contract with the company in China. With the PTR, I believe you own the ADR, which is on a 1-to-100 ratio, and that's direct. So that was another reason that I bought it, because I don't want to own a shell company. So anyway, you know, if you don't take risks, you don't make a lot of money.
Len,
Yeah.
Does anybody else have strategies for the next meeting that belong to the investment club, like Mel, that could share with us of what they do with their portfolios? Does anybody contact you, or do you know of anybody in the investment committee that would be interested in sharing?
Well, I have talked to Frank Rusci. He's the head of the finance committee. He's a CPA. See if he's got some interesting structured products that he's bought over the past few years that he told me about. I'll talk to him and see if he wants to do anything.
Okay.
Other than that, Steve, do you have any thoughts on what we might have next month?
No, I didn't. I haven't really thought about it. We should look at. Somebody should be talking about where inflation's going.
Right.
I mean, that should be a topic.
Is it transitory or long term? Is it creeping or runaway?
Well, it seems to be all over the place.
Right.
Different rates for different sectors.
Mm-hmm.
So maybe there's a strategy in that.
Sure. No, I think that's a major risk going into 2022. I think you're right.
Yeah. So maybe somebody could do some research on that.
Yeah. Well, I'm looking for volunteers. I'm a trained academic and I can talk on anything. I just do research.
Good.
Even if I don't know anything about it, I find out. But that's not a good approach. I'm not an expert. And so my knowledge is limited. Morley and Mike have a professional background. So, but anyway, if there's anyone who would like to talk next month, I'm all ears.
All right, let them notify you. Maybe
Yeah.
they can talk a little bit like Mel gave us, because that gives us an idea of the people that are a part of the investment club. I think that's interesting.
And don't we have people in the community who are economists?
Yeah, I've had someone who I could talk to who's an economist who's spoken to the group before. I'll call him up.
Yeah, I think what Steve brought up, that may be a real challenge late in the fourth quarter and the first half of next year, until we've got an explosive demand in certain parts of the sector of the economy, and we have supply chain issues almost all the way through the economy, not only in the United States, all over the world right now. It's like a bad carburetor on a car, stopping and starting. So I think that may be very helpful for people.
Yeah, that's a good suggestion, Mike. And since we all do Zoom, typically, I think he goes to Florida in October. I'm not sure exactly when, but since we are on Zoom, it could be from anywhere.
Absolutely.
Yeah, so I'll talk to him about it and see if he's willing to be on next month.
Sounds good.
All right. Okay. Thank you, everybody.
All right. Thanks, Len.
Okay.
Thanks.
Have a
Thanks,
good
Len.
evening.
Take care.
Bye bye.